Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management. Okay, off we go. Take it away, Ken.
So a little different today, but same disclaimer at the front end just to take a look at on the back ends. No advice being given on this call. Just contact us today at info@mcnicholasset.com if you have any questions. Yeah, so like I said, a little different of a presentation today just because I was off for most of yesterday. So just wanted to kind of look at a couple charts and pieces of information that I found interesting. Obviously, I saw this yesterday, so I just thought it would be interesting to show, especially for the people, some of our investors watching on the back end. This is just the return of various asset classes this year. They're sorted by 2025 return. You can see the cumulative returns here, and then obviously annualized. Gold, no surprise at the top, but you can see basically everything this year again. Basically the third straight year, everything has worked, other than this year Bitcoin is down about a percentage. Last year it was long duration treasuries, the year before commodities, but we're seeing kind of unprecedented times. Last time we saw this, like a 3-year window this bullish, not really one on here. I mean 2016 and 17, but beyond that, you can see down here percentage of asset classes positive, 3 straight 95%. Obviously after 2022 where nothing really worked. Beyond that, obviously,
does he go back in time, like the late 90s, to see how they stack up like that? There's 3 years in a row, or maybe we can pull the data together.
I mean, you just need a data provider to probably do that, like Bloomberg or something like that. His data, he just posts, it's not a database, he just posts a newsletter, so it's just static, excuse me. But yeah, I mean, it's probably possible with our data provider. We'd have to see. Well, various asset classes here might not have been around at that time, obviously.
I don't know. Most of them would have.
No, but like they're using various ETFs as the proxy.
I see. Yeah, they would have been.
Yeah. But the underlying indices might have been. But yeah. Speaking of, just wanted to highlight this. I was looking at yesterday at the end of the day when I was throwing this together pretty quick around 5:30. Obviously, Nvidia was up about 5% after reporting its earnings. I mean, to say that a lot of people were watching Nvidia's earnings would be understating it. I saw a lot of metaphors towards Nvidia being the last thing keeping the market going. Obviously, there were some detractors against their strong print, including Michael Burry, who's calling out the circularity and improper accounting practices of the likes of OpenAI and kind of even Nvidia, who's a public company. But you can see here a Q3 revenue up about 62%, Q4 revenue expected to increase even more, net income about up 65% year over year, profit margins slightly improved. So you're not seeing a decrease in those profit margins, which originally were worrying many analysts. And then Jensen Huang said that the Blackwell sales are continuing to be off the charts, and his cloud GPUs are sold out, and the demand they're seeing continues to accelerate and compound. Obviously, a majority of their revenue is stemming from the hyperscalers, so that's where a lot of these worries come from. I'll show another slide in just a moment. But for now, it seems like investors are pleased with what Nvidia reported, and the market will continue moving forward. But I still think the risks are obviously there within this AI trade. This is the proportion of S&P 500 companies mentioning AI on their quarterly earnings call. A real surge, obviously, since 23, since AI has become top of mind for investors, consumers, and Wall Street, up to about 62% as of the third quarter of this year. It's the buzzword. No matter what kind of company you are, you're going to mention it, and you're going to have some sort of AI strategy. I mean, even a company we mentioned a couple weeks ago, Yum Brands, in our weekly beacon, has a AI strategy, and it's a fast food company. So very interesting there. This is a two charts that just track basically from a Wall Street Journal article that I was reading. It just basically looks at the global data center spending and where it's going to come from on the right up till 2020. You can see tech company spending, corporate bonds, etc., private equity, private credit. And then on the bottom, you can see bond issuance by the five largest, we'll call them AI tech companies, or five largest, more hyperscalers: Alphabet, Amazon, Meta, Microsoft, and Oracle. You can see the surge in a bond issuance that we've seen since September, possibly a little overdone at this point. You can see that obviously last week's sell-off in some of the tech-related names and even their bonds marked a pretty stark warning for Wall Street, that this trend could be overdone. I mean, Oracle, there's some issues there. Same with Meta. There's some worries that their spend levels, it's not sustainable at this point because their cash flows are not keeping up. I mean, these are the Oracle 5-year credit default swaps, which as of 3 days ago, when I think this chart was grabbed, they're at the highest point since early 2022, when obviously Russia invaded Ukraine. We're not obviously at 15 or 16 or 17-year highs back to the financial crisis, but still that surge, as investors really notice the leverage that's being added on by some of these companies, and that will be needed to be added on, starting to worry some people. And on the other side, same Financial Times article that I grabbed this from, it's reported that the $300 billion deal between Oracle and OpenAI, announced a few months back, is currently worth negative $74 billion. So we'll have to continue to watch that. Obviously, Oracle's gone on a quite the run this year, both to the upside and then obviously pulling back in recent months. And then this is debt to equity ratios of direct AI stocks. You can see the one, we'll call it outlier, Oracle, company to watch probably. This is as of September 16th. It was in a newsletter I read in the past, I think, week. But they didn't update the chart, so could be a little out of date, but very interesting here. And then just as obviously tech continues to see the high risks that we've been mentioning for a couple quarters now, maybe over a year and a half, there's been a rotation into high dividend yield ETFs. The Vanguard high dividend yield ETF has seen some massive inflows basically since June, with the largest coming in September. Perhaps investors rotating out of risk on into more safety, but they still want the equity exposure, so they're not capping their upside. Some lower volatility names, some high dividend yield paying consumer staples, utilities, energy providers. So bit of a rotation we're seeing right now. This is global central bank assets versus the money supply on the right from Crescat Capital. We've seen about a $10 trillion increase in global money supply in the last year. Obviously, central banks are inevitably going to have to expand their balance sheets once again. What do you think will happen with this chart? Obviously, heavy correlation from about 2009 to the peak in 22. Obviously, something changed. We all know that in 22 in terms of monetary policy at most central banks, and something I think is going to change there. Another economic thing that I was looking at, just the Atlanta Fed survey. They now estimate that Q3 GDP growth will be about 4.2%. That's an annualized number, but that's a much stronger number than was previously forecasted. Basically, these strong economic numbers continues to reinforce that, not to the public, but kind of to Trump and his administration, that his policies are working. We haven't seen a reduction in the overall GDP or the stock market. I know the jobs market has been struggling. and we've seen a tiny tick up in inflation. But I would say that Trump probably measures his success as a president in terms of the stock market's performance, number one, and then GDP, number two. So continuing to see some strong numbers there. And then, as I said, obviously central banks could be expanding their balance sheets soon. These are the prices where investors, according to the Bank of America Global Fund Manager Survey, where they see gold trading by the end of next year. The majority see it between $3,500 and $5,000. That combines these top three buckets. Obviously, a very wide range. The majority is expecting higher prices for longer, that this is the new normal for gold prices to be well over $3,000, well over even $4,000, where some of these miners are producing on a huge margin compared to their all-in sustainable cost. So we're going to continue to hold obviously mining positions that we've held for quite some time, and obviously reevaluate that if things change in a macro sense. And then here's a couple, just a quick couple charts on energy. Energy basically at a multi-decade low, other than the COVID shock, in terms of the market cap weight in the S&P 500, sitting at about 2.5–3%, which is crazy when you think about Nvidia is, I think, about 6.5–7%, and the top, I think, 8–9 companies are at 35%. And then on the right, this is hedge funds, their net positioning, basically shorting energy commodities at the highest rate they have ever. This chart obviously only goes back to '02, so it's not that long of a data sample, but you can see the trend, obviously. Just last slide, kind of building off that energy, very hated sector right now. We like a number of names, more of the gassy names, uranium names, but one of them, Williams and Companies, which is obviously a U.S. leader in energy infrastructure, basically full service processing, storage, and delivery. The company has disciplined growth over the years with moderate leverage, forecasted upside. They continue to beat earnings in recent quarters. Very attractive in terms of a valuation standpoint in our eyes. Obviously, they are going to capitalize on the AI energy demand growth, and they're transitioning from a traditional pipeline to a contracted infrastructure company. That's kind of our high level thesis. You can see on the right just their recent earnings in terms of quarterly revenue, quarterly earnings per share, where their revenue comes from. It's pretty diversified, but about 50% comes from the transmission and Gulf. And then over the last year, how their stock price has moved, it's up about 50%. But I think this is as of October because their earnings came out then. But nonetheless, still very bullish on this company. Just an alternative way to get some energy exposure, which we think is a little safer than perhaps some of the companies that are obviously more exploratory. And that's it for me.
Thanks, Ken. Good report. Take it away, Joe.
Okay, thanks. Just a quick update on some dirt, and then some photon assay machines to study even more dirt. So this is Walnut Creek. The site is on the left. The location is on the right, just kind of northwest of Houston, about 58 acres with Connor. And I believe we're going to be putting 100 houses here and leaving some acreage for the pond and a little park. The update is that the Ernst money with the home builders has gone. I know I put 2.6, but I actually called down to Texas yesterday. It's basically done. So the $3.5 million is non-refundable. That's a good sign. It's gonna basically kick off homes being built, which is good. So quick update there. Paragon. Photon assay machines. So when you dig ore out of the ground and study it for the presence of elements, you basically have two sort of standards for doing so. The first is fire assay, which is sort of the old school, typical mining type of look and feel. And then there's photon assays. So basically it's kind of tricky, but you essentially use a linear accelerator to speed up the movement of X-rays. Okay. And when X-rays are accelerated, they become what you call high energy X-rays, and they temporarily change the structure of a molecule into something called an isomer, not an isotope. That's for individual atoms, and that's sort of a different electron orbit. But basically, what happens is these machines, these little jars here next to this lady. So those are the ore samples. So you get ore out of the ground, you crush it, and you put it into these little jars, and basically you put it into this a photon assay machine, which is leased to Paragon by a company called Chrysos, and it fires the X-rays at the sample, and then as the sample isomerically changes, I have a slide on what isomers are, just really briefly. So these are three sugars. Glucose is the one everybody knows about, probably fructose as well. Xylose is another one. They're all the same, right? So the number of atoms and the kinds of atoms, it's just a bunch of carbon atoms, oxygen and hydrogen. What makes these isomers is the shape. And so that's what happens when you fire X-rays at a molecule. It changes the shape of the molecule. And that's why X-rays can cause cancer, because if you fire X-rays at the DNA molecule, it can cause cancers. So if you're a commercial airline pilot or an X-ray technician, you want to be aware of it. Economically, the main thing about this technique of conducting assays on ore samples, and assays is just the scientific word of essentially measuring the amount of sort of a target, material in a broader material sample, is really time, cost, and environmental cleanliness. So there's no hazardous wastes per se for these assay samples. When you do fire assays or chemical assays, you really have a lot of waste byproducts, and they're pretty nasty. So that's the positive there. If you want more information on, actually what these photon assay machines do, you could check it out on YouTube, and it's pretty interesting stuff if you have a degree in mining or physics. Again, these are the isomers, and the client base for this type of business is going to be guys like Barrick and Agnico Eagle and so on and so forth. And so what's going to happen is Paragon is going to set up these essentially labs, right? So these photon assay machines are going to be set up as labs in traditional, mining locations. So like Sparks, Arizona, Sudbury, that type of stuff. And the goal is to, deploy more and more of these units and essentially address this very large market. The market is essentially shifting from fire assays. There's still a very strong, fan base for this. Like if you're that, type of traditional, mining engineer that has a beard and, wears cowboy boots and hasn't flossed in 30 years, you'll still want to do fire assays. But the main investment opportunity is right here in terms of the total addressable market. So what it looks like if you're running one of these photon assay machines at 80% capacity is a monthly profit of about $500,000, which is pretty good. And so it's just a numbers game. We're participating in this financing with Paragon to help get more of these photon assay labs set up, and look forward to updating you guys in the future about how that's all going. Okay, SAT strategy charts of the week. It was very, very, very narrow because the whole world was waiting for Jensen to tell us about how Nvidia did and how much he appreciates Meta and Zuckerberg spending money. It's interesting. You're hearing that hyperscale and AI phrase like all over the industry, right? There's a chicken wing store down the street from my house in Scarborough, and I think they're putting AI in front of the name there to increase business. So very little informational details other than to say, the S&P 500 did cross down through its 50-day moving average. That's resulted in the market being weak. The various indices are kind of what you expect, with the exception maybe of that U.S. Treasury yield. So that's been moving lower. And then the main sort of technical indicator here is going to be the percentage of NYSE stocks below their 50-day moving average, as well as the whole sort of, I guess you could say, risk off trade, to the extent that the QQQs have been, kind of underperforming things like utilities. So that's important. Just looking at some more specific charts. So this report, I think, comes out like Monday night, Tuesday night type of thing. So I don't think anybody didn't think Nvidia would hit their targets. It was more about their forward guidance. And, I know Michael Burry's out saying this is a whole bubble waiting to be popped. But then Jensen came out and said, well, yeah, but our A100 chips are all, at full capacity. Like we can see every single A100 chip that we've ever sold in the whole world. And it's at full speed. So for Andrew's part here, he's talking about 6350 as kind of the main zone. If we're above that, we're okay. If we're below that, it could get a little bit lumpy, but it's still very much within the context of an overall correction. So, a lot of these bears that are coming out with short positions are doing so kind of at a, pretty opportunistic level, I guess. And it sort of becomes a credibility contest. Like if the CEO of Nvidia is saying all of his chips are firing at full power, that's still something. And I guess we kind of got to go with that. So here's the NDX. It has rolled over, but this support zone here looks pretty good. So we'll see how that holds up. Small caps have had sort of, one problem after another. And, we have certainly well underway in terms of sort of moderating our small cap position, which will be nice. It'll sort of smooth out the NAV and the hedge fund there. And then, so this is basically a biotech index, and it seems to be the one area of the market that's kind of, quote, bucking the trend. And, I think the reason for that is this is an area where AI is very much expanding. If you're involved in drug testing or, anything on the surgical side or modeling biological samples, that sort of thing, AI is going to be your friend. Actually, I spoke with a radiologist one time and he told me that nowadays the AI can actually diagnose a radiology study. So MRI, ultrasound, X-ray, almost as good or if not better than a real doc. So that's kind of scary, but it is what it is. And you're seeing biotech, that whole sector, kind of be the beneficiary of that. And then the last one for me is going to be Mr. Bitcoin. Pretty much straight down lately. I think everybody knows that, but Andrew's thinking this is sort of a quote rubber band area, which I haven't heard that term before, but you can see it's almost been kind of pulled down. And I think the idea here is that he's saying, yeah, it could go down lower, sure, but according to his models, presuming this green line here, this support zone holds, it should sort of snap back here. I think what he's getting at is this lower panel. It's really hard to see, but it looks like it is kind of bouncing off this lower end of the momentum range and sort of poised for a big rebound. So we'll see how that goes for the time being. That's it for me, Dave. Thanks.
Okay, thanks, Joe. Chris Curry, do you want to go ahead?
Sure, Dave. I have a short one today. I'm just stepped out of the waiting room at the dentist's office. But yeah, I think bonds are struggling a bit this month, mainly on inflation fears. I think the big news in fixed income was a release this morning of the employment data for September, which showed a way over forecast 115,000 jobs, but the unemployment rate ticked up. And so the bond market is focusing on the unemployment rate, and there's a bit of a rally going on this morning. There's also a lot of revisions to previous numbers, which I want to work through. I think they revised data as far back as July. So, with the government shutdown, the picture has been quite murky, as we all know. And I think this is probably the last big data point before the Fed meeting in December, where the odds of a cut have dropped down to, I think it's in the 30% range. And yeah, that's it for me, Dave.
Okay, good luck with the dentist. Sean, are you ready to go now?
Yeah, can you see that?
Yes, take it away.
All right. So performance has gone from weak to pathetic. Pretty big hit in the month. What's going on with the asset classes? US dollar is strengthening, right? Like right now, it's got decent yields relative to the rest of the world, that's for sure. And as Ken pointed out, the growth looks good. The employment numbers today overall were pretty good. August was revised down to like a negative month. Unemployment is ticked up to like 4.4, which is getting close to the 4.5, 4.7, where I expect, there's going to be more concern. But, Bitcoin, no real standouts in the last week, plus or minus within the distribution. The bias in economics is still dovish. Fed is still in easing mode. A bit of controversy over whether they'll cut or not. These jobs numbers would kind of argue for it, in my opinion. And certainly Trump is putting the pressure on, like even Bessent now, to push Powell. Inflation above target. Notably, rents are falling, and that may be due to weaker employment creeping in. Recession, not yet. US dollar getting stronger. An uptrend, if established, is a general risk-off event. Okay, but this administration continues to support a weak dollar. But if it is heading higher, Bitcoin is going to go lower. And here we can see the US dollar. It had like this nice downtrend, which supported gold and all other risk assets. We've consolidated all through the summer, and it seems to be on an uptrend. Certainly across my the heat map with the blue, yellow, and green there, showing the technical indicators in short, medium, and long term, arguing for continued momentum upward. Gold, nothing stops this train, but I figured out like the only thing that'll stop it is if China starts buying treasuries in preference to gold. I don't see that happening anytime soon. Goldman Sachs is saying that they suspect China's been buying up to 10 times the reported amounts of gold that they say they've been buying. And it's just been the macro trade of the year, right? Like this inert metal just trouncing all other asset classes. If China just keeps buying gold and convinces other countries to do the same, then 5,000, 6,000, no problem. From the Financial Times, the secretive buying has been kind of revealed now. What would cause China to embrace the US dollar again? I don't think anything, right? They've seen what they did to Russia. Oil really didn't do a whole lot this past week, but I will say, like Trump is pushing again for Russian peace with Ukraine and progress on that front. Like if Russia comes back into the world economic order, I don't know how much lower oil can go, like $10 lower, probably. Just not a good looking trend. You see those big splotches of red as like short, medium, and long-term technical indicators go risk off. Just not a lot to be said for oil other than it could be a good contra trade. I've added Exxon and Chevron to my personal trading account, hoping that there's value there. Rates and credit, pretty quiet overall. A little bit of a rally in rates on the employment, but not a lot going on. But like, man, the choppiness of people that have been holding, for example, long-term bonds, right? The Sharpe ratio is only like 0.25 for the past year in like a risk-free asset technically, but it's certainly not volatility-free, right? Like, so you're not getting paid a lot to bear the volatility, right? Here we look at the price performance of TLT over the past year or year to date, just not great, right? Like it's moving around, no trend. US equity last week was fine. Right now, I'd say it's like on watch. Just watch Nvidia. Great numbers. We can talk about that in a sec. The overall earnings trend remains fine still. The VIX term structure inverted on Tuesday. Right now, it's a little weird with spot VIX above the front month contracts, but it's not a disaster. Breadth is weak. I've created a new heat map that goes across like different percentages of stocks above like the 20-day, 50-day, 100-day, percent bullish, and that's, I would say a little bit worse than middling right now. Breadth is weak. The CNN fear and greed index is at extreme fear, right? This is a hated overall rally and people are nervous because they know how good things have been. And it's all riding essentially on one company. So the Mag 7 concentration is a concern, but until there's a shift upward in unemployment to 4.5, 4.7. I think the SPX is one of the only places to be. You can see, one of my shorter term trading signals is flipped to a sell. The heat map has got a majority of the signals saying risk off. And at the bottom, these are the breadth measures. And they're showing that, 6 out of 8 of them are just saying there's weakness in breadth. And the breadth tends to move quite slowly. And when we see periods of like solid red breadth, as we do at the beginning of this chart, it's usually a negative signal. You would only like really act upon it. For example, if we look in the middle of August, right, we didn't really have the technical heat map saying get out. We had a little bit of red, but not a lot, even though the breadth was terrible, right? The Mag 7 impact just can't be underestimated. We go back to 2023 and you can see the dispersion between the S&P 500 represented by SPYs in the red and the equal weight, ETF. And you look at that and it just looks like, you're kind of hitting a top. I don't want to call it top, but you're just not seeing momentum, and that comes through in the breadth. And this is why, right? Like if we look at a performance heat map, just look at the size of these these tech companies. I mean, it's just profound. Look at how small GE is now at the top left of industrials. And GE has knocked it out of the park this year. Like they're up 70% and they split with GE Vernova. There are some companies in there that have done extraordinarily well, like Western Digital and Seagate. I just bought a 5 terabyte Seagate drive for some data stuff I'm doing. You know, along with all of this large language stuff, it's all about data, and data requires storage. And I don't see that trend reversing anytime soon. But you just look across Microsoft, Nvidia, Apple, Google, you know, like even Broadcom, like just it was such a niche player a few years ago, and now look at the size of, you know, the ticker symbol is AVGO. Just extraordinary how impactful tech is, you know. And then now look at energy, just bottom right, just tiny relative to some of these things. Like one Google or Apple is bigger than the entire energy sector. The squares are the size are based on market cap, and the colors based on the year-to-date change. So where are we? We're in the late stage of a truly great equity bull market. Like, I mean, this is the S&P for 15 years, 12% per annum. We've had our lumps, but you know, like our job is to grow capital much faster than the rate of inflation. And just the index has done that for us. And if, you know, we're doing a great job, hopefully we're making much more of this. Last week I said buy Google and short Nvidia. And as of last night, you would have been up about around 5% on that pair trade. I don't know where it would be today. Crypto, this chart is for the past 20 days. The action is down, and that's based on US dollar strength, lack of social engagement. And the worse it gets, the worse it will get to a point, because now it's become somewhat uninvestable. Like somebody looks at what you're holding and it's like, why don't you own more gold? You own Bitcoin, right? And a lot of people have been saying Bitcoin is down because it was up so much from last year. All the new buyers that came in via the ETF have really turned over quite a bit of the initial buying. Harley, you know, I'm still sticking with the potential year-end target of $140,000 per Bitcoin. I think we could see, if we get a couple of things done, and here I'm talking narrative, not price action, a couple of things getting done could really squeeze this higher. I called for support at 85,000. We basically got to 89,000. Things look oversold, as was mentioned earlier by Joe. Legislative process seems to be back on track. You know, we've seen one central bank come out and outright say they're buying Bitcoin experimentally. But it has just not been a fun week, not been a fun month. Again, performance failure on my part. I'm doing what I can to fix it. I think the outlook is actually better, right? Like everyone I talked to in the institutional space was hanging on Nvidia. If they blew it, I don't know what we would be down today. 12%. I mean, that's a monumental number that they came up with. And, you know, like just for fun, as if you don't have enough to worry about, but things have really been good overall in terms of equities and gold and the ability to put money to work in good places. But this yen carry trade, you know, has knocked the market down over, you know, about 10% twice in the last couple of years. And now they're talking about, you know, the Bank of Japan having to raise rates again to fight inflation. Their short rates at 50 basis points, inflation's above 2. If they double rates again, which is what they did the last time that caused the last crack in the yen carry trade, we'll see that again. But again, that'll be temporary, as it was the last time. It could be a good buy the dip opportunity, although I feel like everything is pricey. You know, cracks are appearing. We're hearing more about some regional bank stress, you know, and then watch some of these consumer names like CarMax, Harley Davidson, Winnebago, Lululemon, Visa. You know, if you want to see what's possible, look at the price action in 2023 of some of these smaller regional banks like Zion and Western Alliance. I mean, they got halved in a couple of days. But again, will that end the system? No, right? It didn't end it then. The Fed will step in. They've already made changes at the highest level of banking regulation so that the biggest banks can come in and scoop these little guys up. People talk about Nvidia's valuation. Costco's at 49 times PE. And the thing that I find funny, and you know, maybe Michael Burry's onto something, is like in 2000, and Cisco was a hardware company addressing a new technology that wasn't well understood by the general population and became the most valuable company in the world. Same thing can be said for Nvidia. And the Google model that just came out, Gemini, is just unbelievably good. Like, guys, like if you thought ChatGPT was good or Perplexity is good, what I did yesterday with Google in 3 hours would have taken me 6 solid days of programming. It would have taken me longer to explain to a competent Python programmer what I needed to do than to sit down and just bang my way through my programming issues with Gemini 3. Like, it is profoundly good. I really recommend you all try it.
I read a few articles. I didn't quite understand them about some 4-year cycle in Bitcoin after the halving event. Is there any merit to that, or is that just sort of the cyclicality? Like, why is it always 4 years after they have it that there's these issues?
I mean, a halving event cuts the daily production of Bitcoin by the Bitcoin miners in half, right? So you move up to a different level of scarcity. Typically, there's an anticipation that goes into that there's a rally through the halving. And, just a rule of thumb would say, buy Bitcoin 500 days before the halving, sell it 500 days after the halving. And we're past the 500 day. We're past the sell by date on that. And
Right.
it tends to be cyclical. You tend to get the miners adjusting to it. They tend to have to sell a bunch of the Bitcoin to replace their hardware. So there's something to it, and it's happened 3 times.
Okay. Thank you.
Okay, Sean, great. Thanks. I'm going to go through the morning coffee that just arrived. I guess it's hot, but it's has not been read already. So there's Nvidia, as everybody's noticed, has not brought disaster to the market. So that's, I guess, good news, but it's a matter of time. These valuations are just madness. Okay, let me just go to what the sectors are looking like, the indices. So all the weeklies, you can see they're all turned red for the most part, except for India. And I don't know what they've dropped this index in here for. ex-US, so the rest of the world without that. Yeah, to see how it's underperformed over the 10-year, but it's really coming back now. So I don't know where this missing data is. But Canada's still marching ahead here. Great commodities market, mostly led by gold. Oil certainly hasn't helped, as you can see down here, with oil being down 8%. So that certainly hasn't helped our index. And the venture exchange is doing great, but still the 10-year number is still woefully way below the long-term averages. So maybe that's going to continue. Anyways, S&P 500 and NASDAQ still doing well, with led by mostly the large technology names that we've talked about forever. And the big leadership in Europe, surprisingly, is Italy. I've been following their prime minister. She's got the longest tenure now of 3 years acting as prime minister. I think that goes back something like 20 years. And the average is more like a year. So they changed their prime ministers like almost on a yearly basis, but she's holding herself in there. So good for her. Ken's already mentioned nat gas. That's where we've moved our attention to. We're seeing some good growth numbers there. Gold's taking a pause as silver's down a bit on the weekly, but look at these year-to-date numbers. They're just ridiculous. And finishing up these miscellaneous ones, I'll rely on point and figure, especially for Bitcoin. Sean, I'll show you some what point and figure is looking like for the cryptos here. But starting off with our Canada US dollar, no change, 71 cents, and similar downside targets for both the short-term indicator and the long-term. So yeah, we don't have to worry about hedging. The US dollar spot index is stuck at 100 now and has looks a little bit slight upside. And yeah, oil 59 measures down to 53. Nat gas measured up, so that's where we want to follow this momentum here. Producers measure down, copper up, and uranium up as well. So uranium's back in the spotlight. Gold measures up on the futures to 4,800 and on the spot to almost 4,700. And the bug index, large cap miners are all up. The juniors up huge. We've got one that we're watching carefully in most of our clients' videos. Yeah, fingers crossed on that one. Silver looks very strong as well, as I said before. Here we are with cryptos. So it's got Bitcoin at 91,000 and change, measures up to 226,000. Now, the timing of these things is anybody's guess, but the trend of that is up. Ethereum down and Solana down, and then the whole complex down. So yeah, that's Bitcoin's sort of an outlier there, according to the mathematics of point and figure, which is not foolproof, but it gets the trends right in many cases. Regional banks. So here we are, the big banks measure down, regional banks measure down, and Canadian banks all measure up. They're in good shape, even with the mess of the condo market, especially in the GTA, Toronto market. Finishing up here is on interest rates before I go to my other device and go over Michael Coolbaugh. So the 2 years come off a little bit, should head down to 2.75. The 5 years down, 10-year down, and the 30-year down. So it's ever steepening yield curve is what that looks like. So here we go with Michael Coolbaugh. Job postings on the decline. Despite not having official payrolls and unemployment reports, there's a plethora of alternative data that points to further weakening in the labor market over the past several weeks. Yeah, so they can't hide behind this government shutdown as an excuse that they can't produce data. As he says, there's always other ways. I'm trying to get John Williams to speak to us, who runs his own service where he measures everything from inflation to all sorts of other government data, and I find his to be very accurate. Underemployment rising as more outside labor force wants jobs. So all the Fed members who are now cautioning about easing too fast pointed to a deteriorating labor market as cause for their support in recent rate cuts. Broad-based job cuts surge beyond government. I've yet to see an employment data figure that has improved since the Fed's October meeting, when they last voted to cut rates. U.S. notices of mass layoffs surge, which raises the question of why are they suddenly so confident in the labor market and overly concerned with too much easing. Charts of the day. So he's showing here a U.S. auto loan, serious delinquencies. This is a real problem. You can see the slope of that chart is breathtaking. Look at the deterioration in labor markets. Look at the stress building in private credit. Look at the strain on consumers via loan delinquencies. Is the Fed walking into a major policy mistake? We're actually going to get a private credit specialist. I'm going to be speaking to him in the next couple of weeks and doing a podcast as we hopefully roll out our alternative debt fund. Scale data centers. GW scale 16 gigawatt scale data centers scheduled to come online in 2026 and 2027. That's a lot of gas demand. xAI's Colossus 2 will have 15 on-site gas turbines. Yeah, so there you go. Got to get in front of that. Charts of the day. Amidst concerns of overbuilding, per Bank of America, for the first time since August 05, a majority of FMS investors say companies are overinvesting. This jump is driven by concerns over the magnitude and financing of the AI capex boom. And the cover of The Economist, always a great indicator. This folds in nicely with my point about the positioning and skittish sentiment. Is this another contrarian indicator from the magazine cover? The magazine cover always seems to get things backwards or foreshadows what's about to happen. Systematic positioning index. The recent uptick in realized vol has systematic funds deleveraging and now firmly in the neutral territory, far from the warnings of excessive long exposure. Discretionary versus systematic equity positioning. DB points out the skittishness of discretionary managers net short versus systematics. Is this a euphoria a la 2021? Oh, he's got a ton of them today. And here we are with the DB forecast. Investors don't believe the earnings per share growth at all. Could this lead to a sudden relief rally into Q1 of 2026 if we get strong Q4 2025 earnings? There's been a lot of talk about an impending oil supply glut. Sentiment around oil has been pretty negative all year, having fallen from $72 a barrel to 55. Baker Hughes rig count. Meanwhile, the North American rig count has fallen by 35% since 2022. Cap Resources. A quick update on some of the nat gas names we highlighted last week. Whitecap broke out with conviction yesterday. After breaking out of its downtrend, CNQ broke above near-term horizontal resistance, furthering the odds of a successful trend reversal. Yeah, that's powerful. And that's it for Mike Coolbaugh. Yeah, so that's it for me. Gilbert, last but definitely not least, do you want to cover some things?
Yeah, I'm just gonna make a quick comment maybe on Nvidia since everybody's talking about it, and it was the big story I guess this week, and I did comment on it just a bit last week. You don't have to bring up the chart, but last week I did show a chart which anyone can actually get if they just go to macrotrends.net. It's free, and you just look up Nvidia and you look up the revenue. That chart essentially showed that year-over-year quarterly revenue growth peaked in the first quarter of 2024 at 265%. Since then, it's been coming down, right? The quarter after was 262. I mean, still blowout numbers. The quarter after that was 122%, then 93%, then 77%, then 69%, and then 55%. Nvidia reported, and their sales grew 62% year over year. So after 6 consecutive quarters of declining year over year quarterly growth, we now actually have rising year over year quarterly growth. So that's definitely going to put a pin in the AI bubble talk, right? Everyone was saying that if they miss, the world's going to come to an end. Well, they beat, and the number actually bucked the trend of declining year over year quarterly growth. So that kind of puts things into perspective with regards to the compute and the build out. We don't know how long this is going to go on, but I just wanted to point that out because it's significant that after 6 quarters, we've kind of moved on. So that's it for me this week.
Okay, that's great. Yeah, it's frightening when the whole market balances around one name, and it just reminds me of Nortel back in sort of 1999 to 2000, and that major was that cracked the whole system. And but here's on the CEO of Nvidia is on Bloomberg right now, just talking things up. Yeah, at least this time around, the tech names are much larger, much stronger, and true going concerns compared to the .com names that were just pie in the sky ideas. So it's a stronger market that way, but it's just at unprecedented levels, as we all know. So something's got to change at some point in time. Okay, well, have a good day. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more. Bye-bye.